Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Maybe not so good. You see the stock market moving lower there and you're like, I don't know, bud. This is a little nerve-wracking, right? We have clients all over the United States and one of them's bound to go, this bothers me a little bit. Well, the stock market's actually in what's known as a correction. And that's a fancy way of saying the stock market was at some high and it's fallen 10% or more from that high. That's a correction. Fall 20% or more, that's called a bear market. And so right now we're down about 12, 13%. It's a correction, right? There's no way around it. And so let's say you're out there and you're like, I'm a little worried. This time's different. I think the market's going to go lower. I think that's going to get worse. Well, if you're one of our clients, that could be a problem. See, we're set up in a way where we only grow as a company if you grow your account. That means that we're going to be watching nonstop because we want your account to grow. We don't want it to go down, of course. And so I go, I don't think you should get out of the market. Look what we're doing. You're falling less than the market. Here's all the good things that we're doing, which is true, by the way. And I just don't think you should get out of the market. My best interests are aligned with your best interests in this case. Let's say you go, doesn't matter, Dustin, I want out. Well, let's turn the data around here a little bit and play a game, right? Let's place a bet. Let's pretend you're that client and you say, I got to get out. And I go, okay, here's the deal. If the market goes higher and your investments go higher, you have to pay me whatever the lost gains were. Because we didn't grow as a company, your account didn't grow, I let you down. I shouldn't let you out of the market, right? But on the flip side, if you're right and the market does keep going lower, I will pay you for whatever your losses are. Anybody in on that bet? Think about that for a second. What advisor would do that, right? And I'm not saying we're doing that. This is a fun game, right? Please can't do that with all our clients. So let's say you agree to that bet. And you go, okay, if the market goes lower, I will gladly accept the dollars in exchange for losses. But if the market goes higher, client, I will pay you for the gains that, Jazz and the client missed out on. All right. The first thing we have to do is agree on a time period, right? How long is this bet going to last? Let's say you said, I'm worried, I want to sit out the rest of the year. We go, okay, well, that bet ends at the end of the year then. So if the market is higher at the end of the year, then you owe me whatever those returns were. If you made 3%, we'll take your account, times it by 3%, and you got to pay me that. But if the market's lower than where it is right now, I will give you the difference, right? You guys in on that? Well, if you are, you should ask the data, right? You should say, what are the chances that you, the client, are going to be right? Meaning you're betting on the market going lower, I'm betting on the market going higher. What does that say? Let's see what the probability is of the stock market actually going lower. So this is our email. We actually did this in our notes from Jazz. This is what our clients see here. I'm going to come all the way down here and I'm going to just shrink this sucker for a second. We're going to make it bigger. And we'll go like this. Here you go. So here is your odds of the stock market actually going lower, not higher, because you're on the other side. You're scared. You want out of the market. So this is the probability of the stock market going lower after being in a correction. And here we go. So if you bet on 1 month, that'd be your best. I mean, that'd be your best time period to say, give it a month and let's see where the market's at. 37.2% of the time, the stock market is actually lower over the course of a month after going into a correction. Do you like those odds? Now that you know those odds, would you say, I will bet you, knowing that you only have a 37% chance of being right? Remember a second ago, we said, okay, end of the year. That client said, let's give it the end of the year. I want to sit out, midterm elections, inflation, blah, blah, blah. I'm very nervous. That's about 6 months from now. You got a 28% chance of being right. I'll round up and I'll give you 30% odds on that one. That means I have a 70% chance of being right. You have a 30% chance of being right. Where else would you take that bet, right? You can see that as the further you go out, anything in 1 year or beyond, you have a less than 1 in 4 chance of being right, that the market will go lower. You want to make that bet now? The fun part is I don't know why you would do this, but if you said, give it 20 years, I don't know, right? You'd immediately lose. There is no point in history where the stock market fell 10% and then 20 years later was still down. Now, who's going to make a 20-year bet, right? But you see what I'm doing? I'm illustrating a point here that if you flip the data upside down, and instead of me telling you the odds of the market bouncing, I tell you the odds that, yes, you should get out of the market because it's going lower, not one of these instances here is a good reason for you to place that bet. And of course, I'll hear the same thing all the time. Well, Dustin, I think this time's a little different. We got a midterm elections coming up. Inflation's really crazy here. The supply chain's got some issues, and I worry about interest rates and how the people are going to move into the bond market and take the steam away from the stock market. I've heard them all, right? I'm always analyzing these things. But isn't every time different? Was the financial crisis not different? Was various wars not different? Was oil crises not different? Were trade wars with China not different? Every time it feels like it's a little bit different. But remember the one thing I said in the beginning, price has a memory. Price does have a memory. See, the stock market is just always going to go up. But along the way, these little hiccups, those are news-driven hiccups. And people ask me all the time, Dustin, if the stock market always goes up, then why would anybody ever sell? Emotion, panic, right? It could be portfolio adjustments, but that's not going to move the market. People think that this time's different. Maybe this time's a little worse than last time, but this time is no different. And the next time will be no different. And then the time after that. And so look at the odds of yourself actually being right about being out of the market. And then ask yourself if you want to make that bet. All right, that's all I got for you. It was just a fun one that we did in our email. I do an email every single week for clients just to keep them updated. I actually type out the whole thing, make the data, and show it with them because I like to let them know I'm here. I'm like the only financial advisor that doesn't go play golf 5 times a week. Anyways, check us out at jazzwealth.com, and we'll be back. Let me know what you think. Any one of you want to take that bet with me? Is this time different in your head and you feel like making a friendly wager? See you.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.